Hi, and welcome to the Stockscores Market Minutes for January 7th, 2013. Happy New Year, everyone. This week's topic, finding hotspots. I'll get into that in just a moment. If you're not already a subscriber to my free weekly newsletter, go to stockscores.com/newsletters.asp. I also encourage you to subscribe to this YouTube channel and to watch this video in full HD quality by clicking on the gear sign in the lower right-hand corner of your YouTube viewing window. Well, there's always a bull market somewhere, and the easiest way to beat the market is to find that area of the market that is hot. And so it's important then to have an awareness when you're market scanning and doing your research of the common themes among the strong stocks. For example, in recent weeks, I have found that the solar stocks all took off on one day together in the first or second week of December. Shortly thereafter, the shipping stocks started to all go up together. And more recently today, and also starting in December, the rare earth stocks started to go up. When I see these strengths across a number of different names in a sector, I put those stocks on my radar because it's likely that they will continue higher, obviously because there's a macro effect driving the sector. And that can often lead to market-beating trends in the individual stocks. And by focusing on the area of the market where there is action, you can enjoy the profits that come from finding these hot sectors of the market. So keep an awareness of those as you're doing your market research. All right, let's get into the analysis for this week. I've started tonight, as I always do, with the S&P 500 chart. It has been in an upward sloping channel, but the circle in blue really shows the breakdown around the fiscal cliff issue. As we went into the end of the year, the market was nervous that there would not be a deal before year end. When the market came back in the new year and a deal was done, we basically went back into that upward sloping channel. And so even though there was a really big one-day jump, we shouldn't think that this market is heavily overbought, because all that's happened is we escaped from the worry that the market was under for 6 trading days. And with that said, the market is also coming into some important resistance. And so while I think we've got a few more days of upside, we are going to hit resistance soon, and that should cause the market to go sideways or perhaps see some profit taking in the short term. The TSX didn't see the same sort of selling pressure from the fiscal cliff, although it did see some. The market also gapped up to start the year in Canada, but it is stuck at resistance, unlike the S&P, which is still below that resistance line. The TSX really gapped up into resistance and has stalled there. This is an optimistic chart, and really the TSX has a lot of catch up to do because it has been lagging most global markets. But it does look like this market could break soon. We just need that strong bit of abnormal action in Canada to show us that money is returning to the north. The S&P 500 has been rallying but unable to make new highs, but meanwhile the Russell 2000 was able to break out to new highs with the recent announcement of the fiscal cliff deal as the year started. And so it seems to me then that money is moving into the smaller cap stocks, and I would say that as a trader watching the market every day, I'm feeling like the action is returning to the small cap area. It feels like the retail investor is coming back to the market. The money that looks for those speculative, fast-moving stocks is coming back to the market. And that makes the market a lot more fun and profitable to trade. So that's a good thing. The fact that the Russell is doing quite well here is an important sign. Now keep in mind that although this chart looks pretty good, the Russell and really the small cap stocks have lagged the overall market, and so they have lots of catch up to do. Here's a chart of the Treasury Bond Fund, and I bring this one up as an important chart this week because it broke down from a pennant at the start of the year, and that is a sign that money is coming out of the safety of treasuries and is coming back to the stock market. And this is a very positive chart for the overall market. The US dollar found support and bounced, and it has broken a short-term downward trend line. The talk of perhaps interest rates not staying low as long, or perhaps the Fed not being so happy with their printing press, caused the US dollar to rally a little bit. It hasn't broken the long-term pessimism, but it is encouraging if you are bullish on the US dollar that we have got a triple bottom made in that currency, and we've also broken a short-term downward trend line. So I think that we may see the US dollar actually turn around here. I'm not too bullish on it yet, but I think it is something worth watching. The euro is in an upward trend. It has fallen back a little bit with the strength in the US dollar in recent days, but it has not broken its upward trend line. So I remain bullish on the euro, although I would say more neutral than bullish because we are more or less in a sideways trading range for the last 4 months with rising bottoms, and therefore we can be a little bit optimistic. Gold is in a downward sloping descending wedge pattern, and the reason we call it a wedge is the tops are falling faster than the bottoms. If you break that red line, we should get a good rally, but until you break that line, the red line, I wouldn't get too optimistic about it. I am bearish, but not overly bearish on gold. It just looks like it wants to drift lower, and if it can break out from this falling wedge pattern to the upside, well, then we should get a little bit of a rally on inflation concerns. Oil has bounced back pretty nicely in the last couple of weeks, and we're starting to see some action return to the energy stocks as oil stabilizes and starts to move up again. This, unlike in the past where we were motivated by concerns in the Middle East, I think some of the strength in oil may be that the actual global economy is getting better, and that's encouraging for the market. It is not still a great chart. It's got work to do, but we are taking a step in the right direction. The VIX is moving to new lows. Keep in mind that this is a short-term outlook, and we could get a rebound here as we go into February and people start to worry about the debt ceiling in the United States. But for now, fear is not a factor in the market. So my outlook then is bullish on US stocks. I'm neutral, but on the optimistic side of neutral for Canadian, bearish on gold, and neutral on oil. The US market has resumed its upward trend after the fiscal cliff pause. Canadian markets are ready to play catch-up, but they've still not shown that strong signal that they will play catch-up. Oil stability may help energy stocks bounce back, but in the short term, I think you want to focus on the smaller cap stocks because it seems that that is where the action is right now. Well, that has been the Stockscores Market Minutes for January 7th, 2013. Have a great week in the market and trade well.